If you've been watching the markets at all, you definitely know Palantir Technologies, PLTR. It's one of the most intensely debated stocks out
Oh,
there.
absolutely.
It inspires this extreme devotion from the bulls and, well, equal derision from the bears. And the last few weeks have been particularly volatile. So today we're taking a deep dive into a highly contrarian analysis.
That's right. Our whole mission here is to unpack a view that just completely flips the script on that recent volatility.
Flips the script how?
Well, this analysis argues that the current pullback happening right before their Q4 earnings isn't a red flag at all. It's what they call a golden opportunity.
Okay.
And we really have to get into the core conflict here, which is, this tension between traditional Wall Street metrics and the kind of growth metrics you need for a company in the hyper-growth AI space.
Right. And just to set the table for you listening, the analysis really focuses on that price action that pulled the stock back to around the $177 mark. That's where the battle lines are being drawn. So let's break that down. The analysis calls this the crime scene.
Right.
PLTR closed the final trading day down almost 1.7%, landing at $177.75, and that puts it noticeably off its 52-week high of $207.
And when investors see that, especially with a volatile stock like Palantir, the immediate reaction is often, panic.
Sure, they think the party's over.
Exactly. And that panic is what fuels the whole negative narrative. You hear the bears screaming, bubble, and claiming the AI hype is finally, running out of steam.
They focus only on that drop from $207.
Entirely. But if we pull back the lens a bit, the analysis gives us some crucial context that just changes the meaning of that move completely.
Okay, so what's the context we're missing here?
It's really just simple arithmetic. Despite the dip, despite all the noise, the stock is still up over 130% for the last year.
Wow.
So when a stock has seen that kind of gain, a period of consolidation isn't just common, it's healthy. It's necessary. The analysis sees this not as a crash, but as a healthy consolidation.
Help us understand that a bit more. Healthy consolidation. For the listener at home, how is a nearly 10% drop from the high considered healthy instead of a win for the bears?
Right, because it sounds totally counterintuitive. But a quick vertical rise, it often lacks a stable base. This cooling off period allows the stock to sort of digest the huge gains it's made.
And build a stronger foundation.
Exactly. Think of it like letting cement cure before you build the next floor. The analysis says this stability is essential to prepare for the next leg up, potentially back toward and beyond that $200 mark.
And the analysis pointed to a specific technical line in the sand, didn't it? The $175 mark.
Precisely. This is where the technicals meet the fundamental conviction. The analysis stresses that the long-term uptrend is fine, it's intact, as long as the stock holds the line above $175.
Okay, so above $175, it's a cooling off period. Below that?
Below that, the argument gets a lot weaker. Holding that line signals that enough big money believes in this story to defend that price floor.
So that frames the price action, but it doesn't touch the elephant in the room,
Yeah.
the valuation. This whole thesis really hinges on the idea that the market is just using the wrong yardstick to measure this thing.
It absolutely does. And that brings us to, I think, the core of the whole debate around Palantir.
Which is the standard criticism you hear everywhere. Palantir is too expensive. And they always bring up the PE ratio.
The price to earnings.
The number cited here is just staggering. 415 times earnings. I mean, that number just screams bubble to anyone using traditional investing principles.
And this is where the analysis really pushes back. They argue that applying a metric like PE, which measures what you pay for past earnings, to a hyper-growth company is it's fundamentally flawed.
So PE is for what, a utility company?
Exactly. A stable, mature, blue-chip stock. You don't buy Palantir for what they earned yesterday. You buy them for what they're going to dominate tomorrow. The AI revolution. The PE is backward-looking.
I see the point, but let's pause there. That's the extremely bullish case. Shouldn't we at least acknowledge the risk? I mean, if the PE is 415 and that growth slows even a little bit, the crash would be devastating, right?
That's a necessary check, for sure. And the analysis sort of addresses it by saying that focusing only on PE causes you to miss the key variable, which is the velocity of that growth combined with its sustainability.
Okay, so if we throw out PE, what is the right metric? What does this analysis say we should be using?
They point to something called the Rule of 40.
The Rule of 40.
Yep. This is what the top VCs and private equity firms use to assess elite software companies. The principle is pretty simple. You add the company's annual revenue growth percentage to its profit margin percentage.
And the total should be 40 or more.
40 or higher for a company to be considered elite. It's a measure of balanced, sustainable growth.
That makes a lot of sense. It balances that top-line growth with bottom-line profitability. So the big question, how did PLTR actually do against this elite threshold in Q3?
And here is the aha moment in the analysis. This is why the conviction is so strong. PLTR didn't just meet the Rule of 40.
They beat it.
They completely smashed it. Their Q3 performance came in with a combined score of 114%.
114.
114%. A result that, according to the analysis, is pretty much unheard of in the software industry. Hitting 40 is great. Hitting 114, that signals a completely different trajectory.
114. That completely reframes the PE argument. If your rule of 40 is 114, of course your PE is going to look insane because your earnings are just expanding so fast.
Exactly. The historical number is always out of date. The analysis argues you're basically buying exponential growth at a linear price. And it's not just potential, they have real financial stability now too.
Which means they finally hit GAAP profitability. That's the gold standard, isn't it?
It is. Generally accepted accounting principles. It means they're profitable by the book, no smoke and mirrors. They posted $476 million in net income last quarter. That's a huge milestone.
And why is that specific shift so critical for a tech company like this?
Because it proves two things.
Yeah.
First, the business model works. It's scalable. And second, it shows their products have incredibly high margins. They're not burning cash to survive anymore. They're generating it.
And their balance sheet is described in the analysis as a fortress.
A fortress is a good word for it. They've got $6.4 billion in cash, and this is crucial. Zero debt.
Zero debt.
Zero. And that cash is especially valuable right now in a high interest rate world. It gives them immense flexibility to make acquisitions, ramp up R&D, or just weather any economic storm.
So to use the analysis's own metaphor here, Wall Street is looking in the rearview mirror, obsessing over the PE ratio. This analysis is looking through the windshield at the Rule of 40 score and the AI revolution ahead.
It's a completely different map. The argument isn't that they're cheap today at $177.
No.
The argument is that $177 is cheap relative to where they're going.
That sets us up perfectly for what's next. Let's shift to the immediate ignition source, the upcoming Q4 earnings estimated for February 2nd. What are the key expectations?
The primary expectation is an acceleration of growth, specifically within their U.S. commercial revenue.
That's the segment where they're selling their artificial intelligence platform or AIP to private companies, right?
That's the one. And AIP is really their operating system for data. It lets customers, banks, manufacturers, whoever, integrate their messy data with AI models to make real-time decisions. That's the engine.
And the growth rate there was already huge in Q3.
Absolutely massive. U.S. commercial revenue grew by 121% last quarter.
121%.
And the analysis expects that Q4 won't just maintain that, but that it will actually accelerate further. And this is all tied to a very specific sales strategy they're using,
which the analysis calls the boot camp strategy. Okay, let's drill down into that. What exactly are these boot camps?
So the boot camps are these short, intense trial periods. Historically, selling complex software like this could take, 18 months. Palantir flipped that. They bring a potential customer in for a few days, plug AIP into their data, and solve a real business problem for them right there.
So it's like a try before you buy on steroids.
Precisely. And this high-intensity, immediate value approach is leading to extremely rapid conversions. The analysis says they're turning these trials into massive contracts faster than competitors can even write the code.
And that detail really brings us back to that Rule of 40 score. That success rate in the boot camps must be directly fueling both parts of that rule.
It connects them perfectly. The high conversion rate accelerates the revenue growth. That's the speed. And because AIP is software, those new contracts have huge profit margins, which drives the profit margin part. The strategy is a loop designed to keep that score way above 40.
Looking ahead, analysts are now factoring this into their long-term forecasts.
They are. The analysis cites market projections for full year 2026 revenue to hit $6.2 billion, which is a massive jump from where they are now.
And it all hinges on this next earnings report in February.
It does. The conclusion of the analysis is simple. If Palantir beats expectations in February, if they show that accelerating growth and prove they can maintain that kind of Rule of 40 score, we won't see the stock at $177 again. So to wrap it all up, the core message of this analysis is that the volatility around $177 names, it's not a warning sign. It's just the price of admission for the potential gains. They view the $165 to $175 range not as a floor to panic over, but as an invite to accumulate.
I think the biggest takeaway here for anyone listening is really the discussion around the metrics, understanding why something like a PE ratio is just inadequate for these hyper-growth companies, and how something like the Rule of 40 is a much more powerful tool that's essential for investing in the future.
Absolutely. That Rule of 40 score of 114 is the quantifiable proof at the center of this whole bullish argument. It shows growth and profitability are accelerating at the same time, a nuance the PE ratio just completely misses.
Which leads us to a final provocative thought for you to consider. If Palantir is really positioned as the foundational operating system for the future of AI, and its growth rates are genuinely unheard of, How fundamentally must our traditional 20th century valuation models be reformed to accurately assess the value of companies like this?
Are we trying to measure the volume of a skyscraper using a yardstick designed for a bungalow? That, at the end of the day, is the billion-dollar question that the Q4 report will start to answer.
It certainly is. We appreciate you diving deep with us today. We'll catch you on the next one.